Welcome to the Treasury Update Podcast, coffee break sessions presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. All right, so on this episode of the Coffee Break Session, my guest again is Paul Galloway, Senior Advisor at Strategic Treasurer. And Paul, I just can't, again, every time we have a discussion, I learned so much from your insights and perspectives. So I'm really looking forward to this session around debt funding. How are you doing today?
Doing good. Thanks for having me back to have a short coffee break conversation.
Absolutely. So talking about this, I know as far as, what we've been doing in these past couple of series around investing and really kind of going into more of learning about debt itself into this series. When you think about debt, you think of something negative. When you think about funding, you think of something positive. So learning a little bit more about this topic is going to be really cool. So kind of kick us off here about if you can just give us some insight of exactly what is debt funding.
Yeah, absolutely, Jason. So when you think about debt funding, you think about an obligation that a company has by borrowing funds from somebody or a group of investors to fund a particular aspect of their business. Debt funding can come in various forms. When we say debt funding, what I visualize or I see here is anything from short-term to long-term to different types of instruments. And so when we think of funding on the short side, what companies will do, they will engage in issuance of commercial paper. They may develop a commercial paper program and they issue commercial paper to fund short-term cash flow. Typically it's for operations or something specific that the organization is doing. Probably growing their business or just leveraging short-term cash flow to continue the expansion of what they're doing. Then there's long-term fundings that they can engage in, such as senior debt, which is kind of the most common piece. And so these issuances can be, 2, 5, 10 plus years in duration. And they go to fund typically specific things, although you hear a lot of companies will say use of funds for general corporate purposes, which gives them more leeway to use the capital for a variety of things. Sometimes they use the debt funding to fund, let's say an acquisition. They've acquired a firm or they've acquired some group of assets that is particularly good for the organization, that helps them grow and helps them to continue to support the business.
So I know that you mentioned a couple of examples on some debt funding, but if you can go a little bit deeper here on why would a company really want to issue debt?
Organizations, let's just take a public entity, something that's publicly traded, because there's private organizations that will issue debt just like, a publicly traded organization. But the way they fund with issuing debt is different than you would typically see for a publicly traded organization. But the reason that they would do that is there's components on the balance sheet that make up capital. Yeah, and so if they're looking at the cost of that capital, they'll first look at equity, which is typically really high cost. It's the most costly piece of capital funding that an organization will have. And so you might see something, in the range of 10 to 15% for the cost of equity capital or stock issuance. And what they'll do to offset the cost is they will issue debt at a lower rate. And, let's say in today's terms that depending on the duration, that their debt could be anywhere from, 5 to 8%. And so it's lower cost capital funding than what an equity issuance is. So what they're trying to do is reduce their overall weighted cost of capital and continue to fund particular initiatives that are strategic to the organization at a lower cost.
And what type of debt instruments can they issue?
Some of the typical types that you would hear of would be, senior debt. You might hear them, issue commercial paper for the short term, but they can also do other things that would be more hybrid in structure. So they could issue a piece of debt that has or is treated as equity. And so they call that hybrid debt. And so it has components that are equity-like, but it has components that are debt-like. And these instruments would be a little bit more costly than what senior debt would be. And then they can also issue debt that has components of optionality to it, meaning that the holder of the bond could convert the bond into equity shares. And so that has a different cost component than senior debt. They could also issue, or I guess let's step back and not call it necessarily issuance, but it is a capital raise. It would, I guess, technically be issuance. They could go into maybe a contingent facility. And what that means is contingent capital is you get a group of banks that will back or commit to a contingent capital facility, meaning that they will go to investors to raise the capital based on the terms that you put in place. So you say, I want $500 million of contingent capital, and then you get a group or consortium of banks that will commit a certain level of capital to that $500 million. And let's just, for simple terms, say that you got 10 banks and they all commit $50 million each. You get to $500 million. You don't have to draw on that facility today. That's the contingent part, meaning that you have that sitting on your balance sheet as an opportunity to raise capital when you need it. And there are certain terms that go along with that where you have to pay facility fees on that, even though it's not drawn. And then when you draw upon it, then there'll be a higher cost associated with it tied to the coupon that you agreed to in the terms of the contingent capital facility. So these are kind of unique facilities, but they give you the opportunity to have something on the balance sheet as a hedge against any risk associated with raising capital in the future.
So it sounds like it's a pretty, almost a unique concept as you described it. And as far as almost, there could be some a pretty good upside to both from raising it and as far as even investing into it. So I think you hit on a couple of key pieces here that made it even more intriguing. So is there a limit as to how much an organization can issue?
Yeah, there absolutely is. So when you think about what corporations will do to raise capital is they're going to go to their banking partners. And so they're going to have a group of banks that they go to issue a debt instrument. Yeah, what they're going to do is they're going to do a variety of things as part of their due diligence process to ensure that the investment side of the platform, because you've got an issuer that's borrowing funds, and then you've got investors who are making an investment in a bond that gets put out in the market by this group of banks, right? Well, the investor is going to take a look at, okay, what is this company that's backing this debt? Because that's the underlying portion of the debt that's being issued, that's the underlying backing. What investors are going to look at, okay, what type of company is it? What do the financial statements look like? What is, their line of business? What is their strategic aspects that makes this, a good investment for me given the coupon that they're going to give me? So the investors are looking at it. Before it gets to the investors, what's going to happen is that the banks are going to spend time talking to the corporation. And so they're going to ask questions. They're going to ask information for information. They're going to do an analysis to look at the credit that the organization has. And all that is to say that they believe that the market will be able to withstand a certain size. Let's say it's 500 million. That's kind of where we've been parked at. Let's say it's 500 million. What that is saying is, given the current balance sheet structure that the company has, the future cash flows that they expect to have from that organization, you can go out into the market and the market is going to be willing to give roughly $500 million for this particular issuance. So the limitations can come from what the banks expect they're going to be able to get and what the market's going to do. And typically when the banks go out, they'll do what's called a roadshow. And they'll talk about the company, talk about the future of the company, the credit aspects of the company to sell it to the investors. And by doing that, they'll get a certain level of participation. Well, that level of participation is limited. It's only going to be so much. But what you try to do with these issuances is get more interest or participation than what you expect. Meaning, hey, I want to raise $500 million, but the market is telling me that, hey, 2 times that is interested in this debt issuance. So you have an opportunity during this process that you could actually upsize the issuance. So instead of 500 million, it could be 600 million because you got so much interest and demand and the market was willing to accept that. But there is that limitation. There's a cap to it. You can only do so much. So you can't be a company that's entirely funded by debt alone. There has to be an equity component, and there is a limitation to the full amount of capital that you can have on the balance sheet.
So debt funding, interesting concept for sure. And really, why does a company want to issue it and the different instruments that are available? Well, Paul, thank you for joining me today. Again, it's always just a joy to have a great conversation with you. And for our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or feedback, please send us a note at podcast@strategictreasure.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.